let's talk to the company which has joined us now. NMDC has slashed iron ore prices by 200 rupees per ton for both lumps and fines. This after they had kept the prices constant from April to June 2017. So how does this impact steel companies? To understand this more, we are now joined by RK Goyal, the MD of Kalyani Steel, on the phone line. Thanks a lot, Mr. Goyal, for joining in. First up, this cut of prices by NMDC, how does this aid your margins? Are steel prices really firm enough for you to see a benefit on your margins?
Good morning. In fact, last 6 months, there is already an increase in iron ore prices by NMDC to the extent of around 350 rupees per ton in lumps and fines. Now, this reduction of definitely 200 rupees per metric ton will help. It will reduce the cost, which has gone up much more than this 200 rupees. And as such, internationally, prices of iron ore has come down much more than this increase what NMDC is extending. Rather, when the prices of iron ore was coming down in the international market, NMDC, on the contrary, was increasing the prices. Another important factor is this met coal prices have gone up, even though the coking coal prices are stable or they are coming down, which has another major impact on our costs.
All right. So, Mr. Goyal, if you could tell us, coke prices, as you said, they have been moving higher, while coking coal prices are more or less stable. In addition to that, sir, if I'm not mistaken, I think you import your coke, right? I think from China and Japan, that's from where you import it. So you will also have to pay the $25 per ton as import duty.
You are absolutely right. We are importing our met coke requirement from China and Japan. While there is an anti-dumping duty of $25 for imports from China, on Japan there is no this anti-dumping duty.
Okay.
However, the prices of Japanese coke has been kept in a manner that they are $25 to $30 higher than in Chinese prices. So the traders or the manufacturers in Japan are taking advantage of that situation.
So, Mr. Goyal, in that case, what could the net impact on your margins be? Because on the one hand, you say NMDC cutting prices would aid your margins, while on the other hand, rising met coke prices and you paying the anti-dumping duty could have an impact on the margin. So what is the net offset? Is it a benefit or is it going to be lower than what we earlier did?
You see, as far as if you compare with the earlier times, that means before December, now the coke prices have come down because which has gone up to almost $330 in December, January. It has come down as compared to that. But in between, it had come down to the level of around $245. Which has gone up to around $280, $285. So there is an increase in coke price of $40 per metric ton. While iron ore prices, they had gone up by 350 rupees. Now they have eased out by 200 rupees. So there will be still an increase of 150 rupees. Now all these put together will definitely have a big impact in our manufacturing costs. We are trying very hard with our customers to get an increase in price. Hopefully, very soon we will get something, so it will take care of this increased cost.
All right, so you're trying to push through a price increase. Mr. Goyal, for this year, what has been the price increase? If you could help us out with that number. And last year, you did a top-line growth of around 20%. But I'm aware that you're functioning at optimum capacity utilization levels. So can we see any growth on the top line?
You see, as far as we are concerned, last price increase was in December.
Oh.
And now last few months we are struggling very badly to get a price increase, and hopefully very soon we will get it. So as far as the top line is concerned, since our capacity utilization is close to 100%, it may be to the extent of price increase, not much more than that.
Right. So since you are at 100% capacity utilization and you do have a strong balance sheet, Mr. Goyal, are you looking at some sort of capex? And if yes, which category of steel will you do some sort of capacity expansion in?
We are evaluating continuously the economic environment related to steel in the country and globally. Whenever we'll find something favorable, we will consider expanding our capacity.
Plans for
organically or inorganically.
No plans for defense grade steel?
We are already producing some defense grade steel, but market has yet to grow.
All right, but Mr. Goyal, just to take that point forward, we hear so much about the Kalyani group getting into defense. Will Kalyani Steels, be a player in that? If in fact the group is looking to expand their presence in defense, then where do you see the percentage? The contribution of defense currently, you said, is very small. So what is it currently, and what can it go to going ahead? Because there's a big potential over there.
You see, currently the total order book situation with the Indian OE manufacturers of defense-related products is not that great, but it is expected to grow very high. And once it grows very high, automatically the steel requirement for those components will be much more, and we'll definitely get advantage of it.
So is there a possibility that Kalyani Steel will be the company that supplies steel to all the Kalyani Group defense deals that are taking place? We hear a lot of them, the latest that took place in Israel as well.
Yes, we are definitely looking at that.
And what's the size of that opportunity, if you could give us?
It's very difficult to say anything right now, but defense expenditures are increasing. There is a very big focus on Make in India, including in the defense. So the order book situation for all the defense-related equipment manufacturers will definitely go up. And in the process, we'll definitely get much more business in this space. But it is yet to see to what extent in terms of the quantity will this business will increase.
All right, Mr. Goyal, we'd like to chat with you for a tad bit longer, but thanks so much for joining in.